Hello. All right. So, firstly, we are going to look at who should declare their investment, when one should declare their investment, what are the proofs for their investment, and when and what are the things. Now, firstly, we are going to look at who should declare their investment and why. Now, tax saving investment, as the name suggests, helps you to save the taxes if you're incurring them, right? However, over here we need to understand a couple of items that when it is important, right? So first and foremost, in India, right now, if your income is more than 5 lakh rupees, you are supposed to pay the taxes, right? uh, Up to 5 lakh rupees, from 2.5 lakh rupees to 5 lakh rupees, yes, you need to pay the taxes, but you are exempt from paying the taxes because of Section 87A relief. So, in essence, if your total income is more than 5 lakh rupees, in that case, you need to pay the taxes. However, to compute the taxes, one person should exercise all the caution and take benefit of all the deduction that person is having. Secondly, if you are opting for old tax regimes, in this you should always declare your investment, because unlike the new tax regime, under old tax regime all the deductions are still available, and if you declare your income, it will impact you to get a lower amount of salary. And
Start from again. Like close the starting period.
okay, you can see here. So as I was saying, uh, really very sorry for the technical glitches that we were facing. So let's start it from the top. My name is C.A. Shoykot Roy, and with me we have Rahul, uh, who will be there in the chat box helping you to answer all these questions. And after the session is over, we will do an exclusive question and answer session wherein I will be taking up questions live and solve them as best as I can. In this context, Rahul is an experienced professional, and he has experience of 4 or 5 years in the fields of taxation, international taxation. But he has experience in company matters as well. Now, over here we are going to take a look what are the key takeaways, right? What are the topics that we are going to discuss today? Firstly, we are going to understand who should and when should a person should declare their investment, what can be declared, and when it should be declared. And finally, we are going to take a look uh, if if you do not submit the proofs, what will happen and what will be the remedy for it. And finally, we are going to talk about general things that needs to be kept in mind while during the year, during the financial year. Now, firstly, who should declare their investment and why? Now, person whose income is more than 5 lakh rupees, that person is supposed to declare their investment. Why? Plain and simple. In India, if your income is not more than 5 lakh rupees, in that case, even though you are liable to pay taxes, you are exempt from paying the taxes by virtue of Section 87A relief. So, if your salary income is not crossing 5 lakh rupees, that will not impact your total taxability, your tax liability will not impact whether you declare your investment or not. Even though it is highly advisable, you declare it, but if your income is not crossing 5 lakh rupees, then it will not be having any positive impact. Secondly, any person who is opting for old tax regime, that person must declare investment. Why? Because unlike the new tax regime, under old tax regime, you are supposed to get deductions for all your expenses and investment, right? So, person who are opting for old tax regime must declare their investment. Finally, uh, if you want to avoid paying taxes at the time of filing, you should declare along with your investment all the other incomes that you may be having during the year. For example, You may be having some FD interest, you may be having some interest income, savings bank account interest income, all this income. You can report this income to your employer, and they should consider these items while computing, while preparing your Form 16, and deduct taxes on them. Now, this, if you do this, this can lead to a lot of saving in terms of interest. Right. Now, let's take a look what can be the tax saving expenses. Right. Now, tax saving expenses are mostly fall in two broad categories. One is your house rent allowance, another is leave travel allowance. Now, house rent allowance is an allowance, a tax saving allowance, which is given to you if you are staying in a rented place for the employment purpose. However, over here, people in respect of house rent allowance are under the notion that whatever amount of rent that I am paying, that entire amount of rent can be claimed as HRA deduction. However, that is not the case. In respect of HRA, there are three figures that needs to be kept in mind. Number one, 40% or 50% of your basic salary. Number two, your actual HRA received. And number three is actual rent paid minus 10% of the basic. Now, once we get all these three figures, we are supposed to compare them and take the least amount as your deductible HRA. Right now, over here, people may be having a confusion: what is 40% or 50% of the basic? If for employment purposes, you are staying in one of these four metro cities, that is Delhi, Mumbai, Kolkata, and Chennai. In that case, we will look at the figure of 50% of your basic. Any other cities, we will look at 40% of the basic. Now, you may be staying in Pune, you may be staying in Bangalore, Noida, Gurgaon, whatever it may be, still it will be 40% of the basic. Once we compare these three figures, we will take the least amount, and that amount will be deducted from the actual HRA component, that is your salary. However, please keep in mind the HRA deduction cannot be more than the HRA component in your salary. Right. Now, another tax saving expense that can aid you is your leave travel allowance. Leave travel allowance is something that enables you to travel within India and save some taxes in the process as well. Now, leave travel allowance is allowed twice in a block of 4 calendar years. The recent block has started from 2022 itself, 1st January 2022 itself. Right now, to avail this, you need to travel, number one, within India. Number two, you need to travel by uh, AC first class train or AC three tier train, or you can take a economy class flight. Right. The person who are covered for claiming LTA is yourself, your spouse, and your dependent children. However, there are a couple of caveats over here that needs to be kept in mind again. Number one, the to and fro expenses only are covered. That is, only the train fare or the air fare will be covered. Hotel staying expenses, meal expenses, cab expenses, all these expenses are not deductible. Number two, uh, if you have not claimed any LTA in the previous block, right? If you have not claimed LTA in any previous block, in that case, for the current block, you can claim it for 3 times, right? 3 times or 2 times, 3 times instead of 2 times during this block. So, if you have not claimed LTA, then you can strongly consider claiming LTA for this year. And since the lockdown has opened up, people are actually traveling throughout India. You can take this benefit, you can consider this and save some taxes in the process as well. Right. What are the tax saving expenses? Another as tax saving expense is interest on housing loan. Now, interest on housing loan has a very interesting component as interest, even though you are paying claiming it as a deduction, it actually considered as loss from house property. To claim this, you have to take the loan from a proper bank, and secondly, uh, whatever amount you are paying as interest, regardless of that amount, up to 2 lakh rupees will be deductible in case the loan is taken for a self-occupied house property. Now, self-occupied house property in this context mean a house where you, your spouse, or your parents stay. So there might be a situation wherein you are staying in a different city than your hometown, right? Say, for example, you are a person from Delhi and you are staying in Mumbai for your work purposes, employment purposes. Now you have gone ahead and purchased a house property in Delhi. In that case, and in that Delhi house, your parents are staying, right, who are dependent upon you. In that case, home loan interest can be claimed. Along with that, if you are staying in Mumbai in a rented apartment, HRA can also be claimed, right? So just because your parents are staying in a place, you cannot claim a home loan interest. That is not correct. Even if your parents are staying, you can claim it provided the house property is in your name as well as the loan, right? Secondly, uh, maximum this benefit of this home loan interest can be taken only from the year you started living in this property or you got the possession of the property, right? So there might be a situation wherein you are purchasing a flat which is under construction, and the builder says the house property will be given to you, the flat will be given to you after 2 years or 3 years, whatever it may be, right? However, the loan EMI repayment actually starts from the next month you have taken the loan, right? So in that case, what will happen? Because you will be paying interest for 2 years, right? And 2 years, the amount of interest that will not be a joke. So what will happen to it? Will it go to waste? To answer that, no, it will not go to waste. This interest that you are paying till the house is completed, till that point of time, you need to accumulate that interest, right? How to accumulate? Simply keep a interest certificate with you, make a note of how much interest you have been paying, right? Whatever interest that you have paid during this construction period, that can be claimed in 5 equal installment from the year of house's completion. Only small catch is in that is the maximum deduction for interest is 2 lakh rupees, right? So these 2 lakh rupees will include that 20% installment for pre-construction interest repayment, right? Let's try to understand this situation with an example, right? So let's say in 1st of January 2022, you have, or rather 1st of April 2022, 1st of April 2022, you have purchased a house property which is still under construction, right? You are paying, let's say, 1 lakh rupees as interest. House is completed after 2 years, right? So after 2 years, you will, or rather for 2 years, you will be paying 1 lakh plus 1 lakh, total 2 lakh rupees. Now these 2 lakh rupees will be given to you once the house is completed over 5 years. So in this case, 2 lakh rupees divided by 5 is giving me 40,000 rupees. Now on the third year, once the house is completed, you can just go ahead and take the interest. There is no need for accumulation. So on the third year, let's assume you have paid a interest of 1,20,000 rupees, right? So in that case, what will happen? You will take 1,20,000 for the third year, and 1/5 of the accumulated interest, that is 40,000 rupees. So all in all, you will be claiming 1,60,000 rupees of interest. Now, let's try to understand this scenario with another example, wherein your total interest repayment for those 2 years is coming to again 2 lakh rupees right? So 5 years, that is again giving me 40,000 rupees. However, in the third year itself, your interest repayment is coming to 1,80,000 rupees, right? 1,80,000 rupees. So in the third year, you can claim how much? 1,80,000 rupees for third year plus 40,000 rupees as accumulated interest, totaling to 2,20,000 rupees. However, maximum that you can take is 2 lakh rupees. So you will be able to claim 2 lakh rupees. Remaining 20,000 rupees, you will not be able to utilize, right? And that cannot be carried forward. Now, another section over here is that is over and above section 24B. Till now, we have been talking about home loan interest under section 24B. Now, there is another section which exclusively talks about interest on home loan, and that is under 80EEA. Now, 80EEA is extended to people who are first time home buyers and their house property does not cross a certain threshold limit in terms of stamp duty value, right? So, if you fulfill the conditions laid down in section 80 EEA, you can get another 1.5 lakh rupees of interest benefit on top of 2 lakh rupees that is allowed under section 24B. So, if you fulfill the condition, you can get a deduction of up to 3.5 lakh rupees. Right? What are the conditions for 80 EEA? Number one, the loan should be from a banking institute. Number two, the loan should be sanctioned between 1st April 2019 till 31st of March 2023. Right? The stamp duty valuation of the property should not be more than 45 lakh rupees. And this loan should be taken to purchase first property of the assessee, right? That means you had up till that point of time no house property in your name, be it a purchased property, be it an inherited property, whatever it may be. You should not be having any house property in your name. The flat or apartment, whatever that you are buying, should be the first purchase of property under your name. If these conditions are satisfied, then only you will be able to claim additional 1.5 lakh rupees of interest under section 80 EEA. Moving on. What other tax saving instruments are present under 80C? Firstly, employer provident fund is there. So every month your employer deducts certain amount of money from your salary and deposits the money into provident fund. That actually goes for your retirement. So that part is already taken care of. PPF and VPF, these two provident fund investment happens on your own, right? So PPF, it is opened at any bank. You can deposit the money into any bank, and excuse me, voluntary PF is another PF which is recognized by the law. Now, the maximum amount that can be invested under PPF is 1.5 lakh rupees. These deductions can be claimed under Section 80C. Secondly, tuition fee of children. Now, if your children are dependent on you and any amount is paid for their education or admission to a school or university or a college, in that case, you can take the deduction for all those fees that you have paid. However, any development fees or donation, they are not allowed as deduction under 80C. After that, life insurance premium. If you have taken a term insurance policy from a recognized insurance service provider, in that case, any amount that you are paying to keep that policy alive, in short, that the insurance premium that can be deducted, that can be claimed as deduction under 80C. Furthermore, principal on home loan. We have talked about in earlier slide about the interest component of that home loan. However, the principal component can also be taken as deduction under 80C, right? However, couple of conditions for this is: number one, the house must be completed. Number two, the interest or rather the loan should be taken again from a banking institute. Now, we are going to talk about what are the tax saving instruments are there under ATC. Firstly and foremost, 80CCC, that is pension plan. Any policy that you have taken from any insurance organization for your pension plan, that can be taken as deduction. Employer contribution to NPS. Now, NPS, again, you can take up a contribution in National Pension Scheme launched by the government, and you can take the benefit for it. Or you can ask your employer to contribute in NPS on behalf of you, and you can deduct up to 10% of your basic salary, right? Up to 10% of your basic salary in NPS, which will reduce again your taxable income, and in effect, it will reduce your tax. Furthermore, your own contribution towards NPS. Now, this has a very interesting situation attached to it, because if you are investing in NPS, then it has a very interesting benefit attached to it. Now, the benefit for investing in NPS is that you get an additional 50,000 rupees, maximum 50,000 rupees of deduction under NPS if you are investing through NPS. Let's try to understand how this happens. Let's say your home loan principal is coming to 1 lakh rupees. Your PF is coming to, let's say, 20 lakh rupees, and your insurance premium is 30,000 rupees, right? All in all, you have exhausted your limit for ATC, right? ATC 1,50,000 rupees, it is completely gone, right? So, how will this happen? How will this happen? How will you get the NPS? Now we have exhausted 1.5 lakh rupees. Now, if we are going ahead and making a contribution in National Pension Scheme, you get additional 50,000 rupees. So 1 lakh rupees home loan, 20,000 rupees PF, 30,000 rupees is your insurance premium, and if you make another, let's say, 35,000 rupees of NPS contribution, in that case, under ATC, you will be able to claim 1,50,000 rupees. That would consist of home loan principal, your PF, your LIC, and you will be able to claim the 35,000 rupees that you have invested under ATCCD 1B. Now, this is a very useful tool that can save you some taxes. Also, it can give you a decent return at the time of your retirement. Now, we have talked about the various impacts of tax saving instrument. However, we only have talked about theoretically. Now let's try to understand how the tax saving actually works. Now over here, to understand this, we are going to compare the new tax regime as well as the old tax regime, and we are going to see what impact one person can get if he makes the investment. Now, why we are comparing with the new tax regime? Because under the new tax regime, no deduction is allowed to you. However, the slabs are quite smaller, and the tax rate is quite smaller assigned to each of those slabs. Now, over here, what we can see is a salary structure of a person, right? Salary structure of the person is the person's salary over here is 10 lakh rupees. Basic is 5 lakhs. HRA is 2 lakh rupees, and other allowance is 3 lakh rupees. All in all, 10 lakh rupees. That person is staying in Bangalore for employment purposes. We have considered this so that HRA claim can also be discussed about, right? Now, under the new tax regime, there is no deduction, nothing is allowed, right? So his total salary in this case would be 10 lakh rupees. However, in the old tax regime, you still get the benefit of HRA, you still get the benefit of professional taxes, you or tax on employment, you get standard deduction. All these deductions are available. Now, based on the numbers and the earlier HRA rule that we have talked about, the claimable HRA is coming to 1,90,000 rupees, right? Over here, that person has paid 20,000 rupees of rent. For 12 months, it is coming to 2,40,000 rupees. So again, 40% of the basic, 2 lakh rupees actual HRA, again, it is coming to 2 lakh rupees. But 10% of actual rent paid minus 10% of the basic, that is giving me 1,90,000, right? So from there, standard deduction is there, 50,000 rupees, another 2,400 as professional taxes or tax on employment. All in all, it will give us 7,57,600 rupees of taxable salary. So we can see, just by staying in a rented place and paying rent, that actually impacts a long way by reducing my total taxable salary, total salary. Right. From there, let's assume I have gone for LIC and I have made some other investment as well. Right. For example, I have made an investment in ELSS, Sukanya Samriddhi Yojana, and PF as well. Along with that, I have made myself and my family a medical insurance, right? And which, by way of which, I have completely exhausted my ATC limit. Along with that, 12,000 rupees I have a deduction in terms of my medical insurance. So all these deductions are not available under the new tax regime. Under the old tax regime, all these are available, and your total taxable salary is coming to 6,19,000 rupees, which is significantly lesser than the taxable salary under the new tax regime. Now, income computation part is done. Now let's come to the most interesting part, that is understanding how tax works in new tax and the old tax regime. Up to 2,50,000 rupees, the tax rate is nil for both the regimes, so there is no taxes. However, up to 5 lakh rupees, under the new tax regime, it is 5%. Under the old tax regime, again, it is 5%, so 12,500 rupees. But the situation changes when we go beyond 5 lakh rupees, right? So from 5 lakh to 7,50,000 rupees, the tax rate is 10% under the new tax regime, right? So there is an increase of 2,50,000 rupees. The tax rate is 10%. So 25,000 rupees will be the taxes. From 7,50,000 to 10 lakh, again, increase of 2,50,000 rupees, the tax rate is 15%, which is giving me a tax of 37,500 rupees. Now we all need to add up all these items, 12,500, 25,000, 37,500, to come to know what is my total tax, and by this my total tax is coming to 75,000 rupees. Whereas under the old tax regime, up to 5 lakh rupees, 5% of tax, so 12 lakh 1,500 done. Sorry, 12 lakh 500. From 5 lakh to 10 lakh, the rate is 10%, right? However, the amount that goes beyond 5 lakh is only 1,19,000 rupees, right? So on 1,19,000 rupees, if I multiply by 20%, that will give me around 23,800 rupees of taxes. So all in all, I will be paying around 36,000 rupees of taxes, right? So if I include the sales and everything, I would save around 40,000 rupees of taxes just because I have made some investment. And frankly speaking, now in this day and age, people are much more aware of benefits of savings through various means. It can be ELSs, it can be FDs, tax saving FDs, it can be SSY, whatever it may be. People are much more aware about it. Further, people want to create wealth, and in that way they purchase properties, right? So they may sometimes may take any home loan and all. So all in all, some people who have started their career 3 years, 4 years, 5 years, whatever it may be, they are already into the saving and investment game. So they can exploit this benefit, they can understand, take benefit of all this deduction and stick with the old tax regime. Because if you have those deduction, if you have those expenses with you, the new tax regime does not make any sense for you. However, if you are planning your investment in such a way, in that case, the old tax regime will be much more beneficial for you. Now, over here in this slide, we are going to understand the tax saving through NPS. Now, in couple of slides earlier, I have discussed that if you are investing in NPS, you will be able to save around 50,000 rupees. You will be able to deduct around 50,000 rupees from your taxable income. Let's try to understand how this happens, right? We already talked about 30 with taking example of 35,000 rupees, right? So 1,50,000 rupees goes for your home loan principal and your PF and LIC, right? On top of that, let's assume you are investing 65,000 rupees in NPS. Maximum amount that can be deducted under Section 80 CCD 1B is 50,000 rupees. And if we take 30% of tax, assuming you belong in 30% slab rate and 4% education cess, you will be able to save around 15,600 rupees of taxes if you invest through NPS. Now, let's try to understand how you can go beyond ATC. The most popular option beyond ATC is your Section 80D, medical insurance premiums, right? If you are taking a medical insurance premium for you, your spouse, and dependent children, you can maximum deduct 25,000 rupees. If your parents are covered as well, you can also take 25,000 rupees. So there is a possibility you have taken a medical insurance premium for your parents and you are paying some premiums for it. So you can take another 25,000 rupees. Now, this 25,000 rupees is the maximum limit. If your insurance premium is lesser than that, you will get the benefit of that. If it is more than that, more than 25,000 rupees, your benefit will be reduced to or rather limited to 25,000 rupees. Now, if your parents are more than 60, in that case, the 25,000 rupees limit gets extended to 50,000 rupees. Now, here is an interesting fact. If parents are senior citizen parents are not covered under any medical insurance, in that case, medical expenditure can be deducted and the quantum is 50,000 rupees. However, 2 points you must consider while claiming medical expenditure. Number one, your parents should not be covered under any medical insurance, right? That means they cannot be taken by your side. They cannot be taken from your employer's side, right? They are completely unassured. In that case, medical expenditure deduction can be allowed. Further, if you are supporting a differently abled family person, or you yourself is a differently abled person, or suffering from a specified disease, in that case, there are three sections that can come to your aid. Number one, Section 80DD. Now, if any dependent of yours are a differently abled person and you are paying some amount for their maintenance, their medical treatment, etc., etc. In that case, depending on the disability level, you can take the benefit, right? If the disability is more than 40% but less than 80%, you can take 75,000 rupees. If the disability level is more than 80%, in that case, 1,25,000 rupees. The limit is same for Section 80U. However, Section 80U talks about in case the person assessable under the taxes for the taxes is differently abled. And Section 80DDB. Now, 80DDB is excuse me is if you are incurring medical treatment, medical expenses for a person who is dependent on you for specific diseases. Now, these diseases are A couple of these diseases are cancer, AIDS, motor neuron diseases, etc., etc. Now, having talked about the investment areas, what are the instruments that can be used as investment proofs? Now, try to understand what is the timing for declaration and what happens if you are not submitting the proof, and what can be the remedy of it. Firstly, investment declaration. This window is opened by every employer usually at the end of the year, right? So maybe most of the employers will open this declaration window at the end, last couple of weeks of December, and it will run through the entirety of January. Some of the employers may open it in the month of January, and accept it till they can accept it till the month of January. So most of the organization does this exercise either in the month of January and run it through it, or they can start early, middle of December, and they can run entire month for it, right? However, in any case, you should not miss this window of opportunity. Now, what if you miss this window? What if you forgot or are unable to submit proofs for it? What will happen? First, let's try to understand what are the proofs for. At the beginning of the financial year, that is 1st of April, you are supposed to make a declaration stating your employer that during the year I will be having this much of tax saving expenses, right? It can be HRA, it can be LTA, it can be LIC premiums, anything, right? You let your employer know that these are going to be my tax saving expenses during the year. However, and based on your declaration, your employer computes the taxes. However, at some point of time, you are supposed to take up these expenses. You are supposed to incur these expenses. Your employer wants to know whether you have actually made these expenses or not. And because uh, deducting the taxes, computing the taxes, this task is placed upon the employers by the Income Tax Act, right? They are the people who are liable to compute the taxes and deduct the taxes and deposit the taxes in the names of government against your pay. Therefore, they want to be absolutely sure about their tax computation, right? So, in that case, they want to exercise this thing very carefully, that yes, whatever income declaration you have made at the beginning of the year, that is true or not true. That is why they call for all the proofs. Now, if you have made the investment according to the proofs, or your proofs are in line with the declaration that you have made, in that case, there is nothing to worry about. You get out with flying colors. However, if there are any discrepancy, your employer will ignore that particular declaration, and compute taxes ignoring it, thereby increasing your taxable income, and thereby increasing your tax payable as well. For example, during the year you have made a declaration that I will be making a LIC premium of 1 lakh rupees, right? But in reality, you have made a declaration, or rather, you have invested only 50,000 rupees. Remaining 50,000 rupees, your employer will add it back, compute the taxes, and they will be withholding that amount of taxes. And this tax withhold practice will be happening in last 3 months. So your last 3 months take home salary can take a hit if you are not submitting the proof. So be very careful. Now, what happens if you miss it, right? There can be a really practical reason. Say, for example, you have taken a LIC policy, but the premium due date is last week of February, but your investment declaration falls or closes on 31st of January. In that case, there are two ways. Some of the employers, what they do is they allow you to submit the proof they allow you to submit the premium paid receipt of last year along with the policy document, right? Wherein it is clearly mentioned that you need to pay XYZ sum of money in the month of February, whatever the date it has mentioned. Or some employees don't really entertain that, they completely ignore it. So, in that case, what you can do is you will be obviously making the insurance premium in the month of February. At the time of filing your income tax return, you can claim that deduction and get the excess money that was deducted from your end refunded to your bank account. However, this process actually involves filing the income tax return, e-verifying it, and getting it processed. Then only you will be able to get the refund. Now, we are almost at the end of our session. Now, I would like to talk about a couple of things that you should keep in your mind. Most important being is during the year, if you are switching the job, during the year, if you are switching the job, then in that case, there is a possibility your new employer does not know any earnings of your previous employer and any tax deduction of your previous employer, right? So, what will happen in that case? They will give you the basic exemption limit all over again. They will consider the LIC declaration, ATC declaration, ATD declaration, whatever it may be, all over again. They will give you standard deduction benefit all over again. In reality, you are supposed to get this deduction only once in a year. However, if you switch the job and do not let your employer know, they will deduct, they will consider all over again, and they will deduct a lesser amount of taxes. Now, why I am bringing this to your notice? Because if lesser amount of tax is deducted, right, at the time of filing your income tax return, if tax liability is more than 10,000 rupees, that is, you need to pay 10,000 rupees, more than 10,000 rupees. In that case, advance tax liability comes into picture, wherein you need to pay some money in advance to the department, to the government. And you could end up, just because you have missed this opportunity, letting your current employer know about your previous employment, you could end up paying a huge amount of interest just because you have not paid advance amount of taxes. Therefore, if you are switching the job during the year, or if you have switched the job during the year, go through your tax computation from your current employer, right? Check whether they have considered the previous employment salary, whether they have considered previous employment taxes as well. If they have not, let them know, reach out to them so that they can do the tax computation and deduct the taxes in proper way, so that at the time of filing you could save yourself a huge amount of interest payment, right? Another thing, another way you can check is, obviously, if you are switching the job, obviously you are switching the job because you are getting a hike, right? You are getting a standard hike, right? A handsome hike, I would say. So, if this is happening, your income is going up. Therefore, whatever of tax deduction that's been happening, that should go up as well, right? However, if your employer is not deducting taxes at that level, don't you don't really need to be happy in that case. You need to be concerned whether they are doing the tax computation correctly or not. If you are under the suspicion they are not doing it properly, you can talk to your payroll team, you can talk to your HR, whosoever is in charge of these things, and get these things sorted out. Now, we are presently at the end of our session. Thanks for joining us. Now, I will be going through the questions.
Traditions. We have many questions on that. We have many questions for capital gains and insurance.
Yeah.
rent paid in excess of 1 lakh in cash. No PAN available.
Okay.
You tell it.
Right. So there is a question. There was a question. Uh, if the rent paid is more than 1 lakh rupees, what will happen to it? Now, if rent paid is more than 1 lakh rupees, then you are supposed to quote the PAN, right? You are supposed to quote the PAN to your employer. However, at the time of filing your income tax return, you could compute the HRA on your own and actually claim the amount on your income tax return. However, it's better to get a rent receipt and signed by the landlord, number one, and it's ideal to get or rather pay the money through banking channels so that at later point of time, if income tax department comes back to you, you will be able to substantiate by saying, yes, I have paid this money, I have the rent receipt to prove it, I have the bank transaction to prove it. Right. Another question is coming up that what is the maximum amount of LTA that can be claimed? Now, there is no such limit of LTA per se. However, the maximum amount of LTA that can be claimed is the amount declared by your employer. Right. So every organization has in their salary structure LTA component embedded in it, right? If your salary structure has a LTA component embedded on it, that is the maximum amount of LTA that can be claimed. However, again, I would like to reiterate, only to and fro expenses are allowed as deductible. That too, either economy class airfare or AC first class or is 3 AC seats of train. Meal expenses, cab expenses, hotel staying expenses, all these expenses are not allowed as deduction. Okay. Now another question is coming up. If I do not have LTA component in my salary, can I claim LTA? Well, in that case, firstly you need to get LTA component in your salary. Let's try to understand with a scenario, right? You have a normal savings bank account. Over there, you have, let's say, $10,000, 10,000 rupees, right? You cannot withdraw 30,000 rupees or 40,000 rupees from that savings bank account, right? So, if your LTA component, if your salary structure does not have a LTA component, in that case, you cannot claim any amount as LTA. Okay. Another question is coming, that is 1,50,000 is claimed through LIC and SSY. Then also NPS is applicable. I am assuming the question is about additional 50,000 rupees, which I had talked about. If that is correct, then yes, you can take another 50,000 rupees of deduction if you invest in NPS. However, it will not be coming under 80C, it will be coming under 80CCD 1B. LIC and SSY will cover 1,50,000 under 80C. NPS additional 50,000 rupees will be covered under 80CCD 1B. Well, yes, in case the house property for which the loan has been taken is under two owners, right? And the loan paper is also under the name of two owners. In that case, the interest component and the principal component both will be split evenly between the co-owner slash co-borrower, and they both can take benefit provided they can take the benefit. Individually, though, the limit will not be crossing 2 lakh rupees. So if the joint loan is let's say giving a interest of 3 lakh rupees, then each party will be able to claim 1,50,000 rupees, 1,50,000 rupees in their individual income tax return. If the loan is taken on 2022, October of 2022, if the house is completed, then yes, you can take the interest component as well as principal component in that year. The key part is the house should be completed. If not, you should be able to accumulate the interest component and claim it over 5 years once the house is completed. Security deposit paid cannot be claimed as HRA because that is not the amount of rent that you are paying, and security deposit you are getting once your tenancy period is over. Therefore, it cannot be claimed. No, you cannot claim rental car for travel. Only two modes of transportation is mentioned, that is air and train. Nothing else. No bus, no rental car, nothing can be claimed under LTA. No, employer's contribution towards NPS cannot be considered under 1.5 lakh rupees limit under ATC. That is considered separately. Right. So one question is coming up: stamp duty value in respect of ATEA. No, market value is not the stamp duty value. The stamp duty value is the value on which you pay the property taxes, right? So at the time of registration, you need to pay a certain amount as registration fee. Now that registration fee is calculated based on the stamp duty value, the stamp value of the property. If the stamp value of that property is not more than 45 lakh rupees, in that case, Section 80 EEA benefit you can claim. That is on top of Section 24B. Now, we are almost at the end of our session. I would really like to thank all of you for joining today. Hope you understood something about tax saving declaration and what to do, and hope you understand and take some understanding of taxation, which would plan your finances better. Thank you. Thanks for joining with us.